Okay, thank you. Hi, everyone. Good morning. I hope uh, participants are joining in. So I can wait for a minute so that everybody who is in process of joining can join, and then effectively we can start. I'll wait for 1 minute. In the meantime, whoever has joined, please, confirm in the chat box so that I get to know you are joining in. Good morning, Viraj. Good morning, Shailesh. Others can also please write in the chat box so that I get to know. Good morning, Shruti. Good morning, Kushma. Good morning, Abdul. Good morning, Yukta. Okay, so this is the time to start our today's session. So a very good morning to everybody. I hope you had good celebrations and you enjoyed this Diwali. Now you are back for the session. So we'll continue with the remaining portion of the session which we have been discussing day before Diwali. So we were talking about IND AS 37, right? Provisions, contingent assets, and contingent liabilities. So what we have done in the previous session is we have understood the meaning and definitions of all these three items: provisions, contingent asset, and contingent liabilities. How and when provision needs to be recognized. If provision is not required to be recognized, then do we have a disclosure requirement around contingent liability if the chances are, not remote? And if the chances are also remote, then disclosure of contingent liability was also not required, that we had discussed. Regarding contingent asset, whenever the right to receive, is established by the entity, then only, we can disclose, we can recognize the asset. Prior to that, it is all contingent because this right to receive something is, to be confirmed by some future event. So that's why there is a contingency involved. Hence, contingent asset cannot be accounted for. Only disclosure, we have to do under the IND AS for contingent assets, right? So that's all we had discussed. Thereafter, we have done some practicals, some different scenarios when, there would be a obligation, constructive obligation and legal obligation. If there is either a legal obligation or the constructive obligation, and that obligation is resulting into a present obligation, right? So we would be required to recognize the provisions. So we have done whatever the criteria needs to be complied with in order to recognize the provisions. So that's all discussion we have done. Thereafter, we have come to a measurement. So how and when the provisions needs to be recognized, then what would be the measurement criteria? So we have discussed that most likely outcome method and best value method, best estimate method, right? So these are the two methods which we had discussed in the previous session. So expected value method and most likely outcome method. So most likely outcome method applies when there is a binary output. So either there would be a liability or there wouldn't be the liability. In that case, only most likely outcome method, is applied. If there are outcomes more than two, then expected value method, needs to be applied basis on the probability weights assigned to each outcome, right? Then we have done this practical. So where, the defects were of three types: no defects, minor defects, major defects. Since the outcome is more than three, so we had applied the expected value method in this case, and basis on that we have computed the provision liability, right? Then we have done some one question around most likely outcome method as well, where there were chances of 60% of incurring a 1 million liability. So in that case, what we have done, because chances are more likely than not, so we have recorded the 1 million liability in full, because while applying most likely outcome method, we do not use the weight or probability factor in computing the value, because it is a yes or no case, right? So that's all we had discussed. Now, as I mentioned in my previous session, that under IND AS 37, there is one big difference in IND AS versus IGAAP. Under IGAAP, whenever we have been calculating the provision amount, we never used discounting, right? But under IND AS 37, discounting has to be done if the liability to be settled is liability to be settled is getting after 12 months from the reporting date. So if there is any provision liability which needs to be settled after 12 months from the reporting date, then it means it is a long-term provision. So those provisions needs to be discounted at appropriate discount rate, right? So under IND AS 37, whenever there are any provisions needs to be measured or calculated, we always need to think whether there is a discounting required or not, basis on what is the timeline when this liability will be settled, right? So what the standard says around this, where the effect of the time value of money is material, right? So if the time value of money is immaterial, so if any liability is to be settled, after 6 months, 9 months, 12 months, then, in that case, discounting is not required. But if it is to be settled after 12 months, then we need to see if the discounting is required or not. The amount of a provision shall be the present value. So if 50,000 has to be settled after 3 years, then we will discount the 50,000 at some discount rate for 3 years to arrive at the present value of that 50,000, and that amount will be recorded as a provision as on date. And then every year we will calculate the unwinding of interest, and we will increase the provision amount every year, right? Unless and until it gets settled. So present value of the expenditure expected to be required to settle the obligation. So we need to compute the present value. Now, around the discount rate, standard says it should be a pre-tax discount rate. Okay. Please keep this in mind, always pre-tax. Okay. That reflects current market assessments of the time value of money and the risks specific to the liability. The discount rate should not reflect risks for which future cash flows estimates have already been adjusted. So there are two adjustments which discount rate should not have. Number one is the risk adjustment. So if the cash flows are already risk adjusted, then discount should not be adjusted for that risk, right? Otherwise it will be double counted. If cash flows are not adjusted for the risk, then only discount rate needs to be adjusted for the risk. So we'll understand this through this example. An entity has a provision for which expected value of cash outflow in 3 years time, right? So here the time period is 3 years, right? So it means time value of money is material, hence discounting becomes applicable, because the standard uses the word when the time value of money is material, then discounting needs to be done. It's not that discounting has to be done in 100% of the cases. If by any chance management comes to the assessment that this time value of money is not material, then they can go and recognize the provision without the discounting, right? But they have to disclose why the time value of money is not material in this case. But if it is material, generally it is always considered as material when the liability is to be settled after 12 months from the reporting date, right? So there is no exception to that rule. So 3 years time, we need to settle 150, right? And the risk-free rate is 5%. So what is this risk-free rate? Risk-free rate where risk is not adjusted, right? However, there is uncertainty regarding the outcome of the outcome, and the entity would settle instead for a certain payment of INR 160 in 3 years time. So 150 was expected to be settled within 3 years, but because of there is some uncertainty, so 160 would be the amount that needs to be settled in order to capture that uncertainty or the risk involved in the cash outflow, right? Now, how we will calculate the present value in this case? If the cash flows are adjusted for the risk, then the discount rate at risk-free discount rate, right? So either the cash flows needs to be adjusted for the risk or the discount rate needs to be adjusted for the risk, but it can't be both. So we cannot come and say that cash flows are already adjusted for the risk and we adjust the discount rate as well for the risk. So if cash flows are adjusted, discount rate should be pre-risk, pre-adjustment of the risk. If cash flows are not adjusted, then discount rate should be adjusted for the risk. Now, in practical life, always cash flows are, adjusted for the risk, right? But in examination question, it can be either way, right? So you just need to think whether the cash flows given in the examination are risk adjusted or not, right? So that you need to decide first. Thereafter, you come to the discount rate and, see which discount rate needs to be used. So present value in this case would be INR 138. So 160 is the risk adjusted cash flow discounted at the risk-free discount rate, right? So 160. So 150 was the idle cash outflow expected. But when we adjusted the risk factor, then it became 160. Because of that risk, my expected cash outflow increased from 150 to 160, right? So that 10 rupee adjustment I have already made in the cash flows, future expected cash outflows. Hence, I will be using the rate at a pre-adjustment of the risk. That is the risk-free discount rate, 5% in this case. So 138 would be the amount by which provision should be recognized as on date. Now, if the discount rate is adjusted for risk, then discount at the risk adjusted rate, right? So in this case, 150, that is the cash outflow without risk adjustment, will be discounted at a risk adjusted discount rate of 2.8% so that we get 138 as the present value. Now the question arises how this 2.8% has been arrived. It is not given in the question. So assuming in the first scenario 138 is the present value, what would have been the risk adjusted discount rate? That's what we have tried to calculate here, just to showcase that if the same present value has to be arrived, then risk discount rate would have been 2.8%. Otherwise, in the examination question, either it will be given or you might need to apply a CAPM model, right? Which you are already are aware of, right? So this is how the present value needs to be calculated. So the thumb rule is either the cash flows are to be risk adjusted or the discount rate is to be risk adjusted. It can't be both, right? That's the key message which we need to, remember. Let's do this question. Beta has an obligation to restore the seabed for the damage it has caused in the past. Okay. Now, this company might have been extracting oil from the seashore. Hence, they have, inserted or, installed oil rigs in the seabed. So they have done some damage. Now they have a liability to restore the seabed to its original condition after the operations of extraction are completed, right? It has 1 million cash to pay on 31st March 2025. So on 31st March 2025, they have to pay 1 million cash in order to get this restoration done. Beta's management consider that 15% is the appropriate discount rate. The time value of money is considered to be material, right? So what would be the present value in this case? So 15% is the discount rate given and 1 million is the cash, right? calculate the amount of the provision to be recorded in the books as on 31st March 2023 for the cost of restoring the seabed. So very simple answer. 1 million needs to be discharged after 2 years. So we will discount it at 15% for the 2 years. So value will come 7,56,144 rupees, right? So what entry I will record in the books as on 31st March 2023? So the entry would be P&L account debit to liability or provision for site restoration. Okay. So 756, 144, 756, 144. Right. So this would be the journal entry, which I will be recording as on 31st March 2023. Now, in the next year, what I will do? I will calculate the interest component on this item for the next 1 year. So into my 15%, right? So suppose this amount comes, whatever amount comes, then I will record the entry again. So again, interest expense account debit to provision again. So I will increase the provision liability for the next year, and the same exercise I will be doing in the next to next year. And by the time I reach to 31st March 2025, 1 million, that is 10 lakh, would be the amount which would be showcasing in my balance sheet, right? So this is how the provision needs to be discounted and unwinded year on year to record the liability. Any questions? Let me know in the chat box if anything anybody wants to ask. Okay. So let's do one more practical on this. E Limited becomes subject to an obligating event on 1st of January 2015. D Limited is committed to expenditure of 10 million in 10 years time as a result of this event. Appropriate discount factor is given as 8%. Calculate the provision liability as on 1st of January 2015, 31st December of 2015 and 31st December of 2016, right? So in 10 years, we need to discharge 10 million, right? So 10 million has to be paid after 10 years. Then what would be the amount of provision which I need to record as on 1st of January 2015? That is the date on which this obligation has arisen, right? So appropriate discount rate already given in the question, 8%. And then I need to also calculate the provision for the year end 31st December 2015 and the year end 31st December 2016 as well, right? So this is what the ask from the question. Okay. On 1st of January 2015, initial measurement of the provision would be 10 million into May 1 divided by 1 plus 0.08 to the power 10, right? This is the formula for, computing the present value of any amount. So this gives us the amount of rupees 46,31,935 rupees. So this is the present value of the 10 million liability to be paid after 10 years, right? So this is the day one liability. What entry I will record in the books as on day one, that is 1st of January 2015. Expense account debit to provision liability account, 46,31,935, 46,31,935, right? Now, at the year end, so I need to give effect of 1 year interest unwinding. So I will remeasure my provision liability. So there are two ways of doing it. So either you apply the same formula for 9 years now, or you can simply, apply the discount rate on the present value. So either way you can compute, but this method is always, suggested, right? So what I will do, 10 million into me 1 divided by 1 plus 0.08 की power 9, right? Because now 9 years are left. So the amount comes to 50 lakh 0 to 490. So this is the amount which should be the provision amount in the books. Now, how much I have already recorded in my books? 46 lakhs. So what I will do, the differential I will calculate. And this differential is pertains to the borrowing cost. That is the interest cost, unwinding of the discount, right? So this will hit my borrowing cost, interest expense in the P&L, and the liability, that is the provision. So amount entry would be interest expense account debit to provision by this much amount, right? This would be the year end entry. Then for the next year, what I will do, I will do the same exercise again. So measurement of the provision 10 million into 1 divided by 1 plus 0.08 power 8, because now at the end of the next year, that is 31st December 2016, 8 years are still to go. So for 8 years, I will compute the present value. This will give me the 54 lakhs. How much I have already recorded? 50 lakhs, right? So the delta is 4 lakhs. So this 4 lakhs now will be recorded as on 31st December 2016. Entry would be again same. Interest expense account debit to provision. So provision will, keep increasing year on year. And when you reaches the 10th year, it will give you the 10 million amount, which needs to be settled on that date. Until settled, this 10 million will continue in your balance sheet, right? So this is how the provision needs to be discounted, and unwinding of interest component needs to be done for each year, right? Now, the question comes, if any listed company is, preparing the quarterly results, then for each quarter, do we need to, adjust this unwinding cost? Yes. So what we will do, we will accordingly adjust this for quarter, half year, or whatever, at whatever date, the financial statements are being prepared. So for that period, this unwinding has to be done. Okay. So Yukta is asking in example one, how we got the 2.8%. So I had already told that 2.8% is the expected rate at which I will be getting the same present value. So in that case, I have assumed that the same present value would be arrived. So what would be the, expected discount rate? So in that fashion, reverse calculation was done. Okay. Would your answer be different if the obligating event is in respect of a decommissioning liability of the PP&E, property, plant and equipment, under IND AS 16, right? So now in this case, there was no PP&E. The only fact mentioned in the question is that D is committed to an expenditure of 10 million in 10 years, right? So 10 million will be incurred after 10 years. So we have computed the provision. Now the twist is that if this 10 million pertains to a decommissioning liability for any of the property, plant and equipment, then what would be your answer? Would you like to try? What would be the answer in this case? I hope you must have studied IND AS 16 property, plant and equipment already. You must have studied the concept of decommissioning liability, how the decommissioning liability needs to be computed, and what are the journal entries, we need to do while recording the decommissioning liability. Any idea? What is the journal entry? Okay, forget about this question. Just tell me what is the journal entry for recording decommissioning liability. What needs to be debited? What needs to be credited? Tell me in the chat box, please. Able to recall? Not able to recall. Asset account debit to decommissioning liability provision account. Right, Mohammed. So this is the entry. Now, in this case, what would be the entry? Earlier, we have been debiting what? The expense, that is the P&L. Now, because we know that this provision is related to the decommissioning liability, the only change would be that instead of debiting the expense account or the P&L account, we will be debiting the respective PP&E asset to which the decommissioning liability belongs, right? So that PP&E asset will be debited and the provision will be same. Then again, we will unwind. So unwind will be debited to the borrowing cost and provision will be increased, right? So this decommissioning liability, which is being debited to the asset on the day one, will start getting depreciated as well over the useful life of the asset. Yes or no? So this is how the entry will be reflected. Expense account debit to provision 370, that is the year end unwinding. And then debit expense to credit accumulated depreciation. So this is the depreciation amount which will be hitting to the P&L. Now how this is computed? The day one present value of the decommissioning liability was how much? 46,31,935, right? This much we have debited to the asset, right? So this will start getting depreciated over the useful life. So here, that because the useful life is assumed 10 years, so assuming the method is SLM, so we will be depreciating the amount over the 10 years. So this will be the depreciation. This will be the interest cost for the unwinding at the end of the year one. So total expense hitting to the P&L would be 8,33,748. So this will be going to the depreciation account in the P&L and this will be going to the borrowing cost, right? In the P&L, right? Entry is clear. Any doubt on this entry? Then at 31st December 2016 as well, what we will be doing? The same calculation which we have been doing earlier. Now the liability provision amount comes to 54 lakhs. 50 lakhs has already been recorded, right? So 4 lakh is the delta. So 4 lakh would be hitting to the borrowing cost. That is the P&L, right? So P&L to provision, right? So liability will again be increased by amount of 4 lakh and we will be again calculating the depreciation. Depreciation will remain same throughout the 10 years. So 4,63,000 will be the same amount of depreciation, right? So the total amount hitting to the P&L for the year two would be the summation of these two expenses, right? So 8,63,392 would be the amount. Easy. As such, no complication. Try to be, responsive in the chat box. Okay, thanks Shruti and Abdul for the confirmation. Okay, so again, this is the question from your study material only. X Solar Power Limited, a power company, has a present obligation to dismantle its plant after 35 years of the useful life. So what is the useful life of the plant? 35 years. So after 35 years, it needs to be dismantled. As Solar Power Limited cannot cancel this obligation or transfer it to third party, X Solar Power Company has estimated the total cost of dismantling which will be incurred is 50 lakh and present value of the same is also given in the question 30 lakhs. So after 35 years, 50 lakh needs to be incurred for dismantling the solar plant, right? Now, at today's date, present value is also given in the question itself, which is the 30 lakhs. Based on the facts and circumstances, X Solar Power considers the risk factor of 5%. That is the risk that the actual outflows would be more from the expected present value. So 5% is the risk factor the company is saying. So it may deviate by 5%. So 5% additional amount might be required to be paid, right? How should X Solar Power Limited account for this obligation? So 50 lakh is the amount which will be incurred after 35 years. 30 lakh is the simple present value given in the question. Discount rate is not given and risk factor is given at 5%. That is the amount payable may deviate by 5%. That is 5% might be required to be paid additionally. That's what the facts of the questions. Now, you need to tell me by what amount we will be recording the provision as on day one. Just think through. Let me know your responses in the chat box and then we will definitely discuss. Any luck with the answer? $30 lakh to be recognized on day one, Mohammed is saying. Okay. So 30 lakh provision needs to be recorded, right? So you are suggesting entry would be expense account debit to provision liability account, 30 lakh, right? Okay. Others? Shruti is saying 31,50,000 needs to be recorded on day one. Okay. Okay. Finally, let's see. So the obligation should be measured at the present value given in the question, right? So what is that? 30 lakhs. So 30 lakhs is the present value already given in the question. So we know that this is the present value. Now, because the question is additionally talking about the risk adjustments of 5% needs to be done. So 30 lakhs into my 5%, 1 lakh and 50,000 would be made. So 30 lakh plus 1 lakh 50,000, that is 31 lakh 50,000. Now, why we have done this? Because in the question, what the question is saying, based on the facts and circumstances, X Solar Power considers the risk factor of 5%, the risk that the actual outflows would be more from the expected present value. So this is the present value given in the question, and on the top of that 5% additional risk factor, the company is estimating that there will be additional 5% payout for the risk involved, right? Or the measurement uncertainty. So in this question, because it is given in the question that 5% risk is involved, so we will it is implied in the question that the discounting, of the cash flows was done at a before the risk adjustment. So cash flows, were not risk adjusted. So the risk now needs to be adjusted. Getting my point? So what I have said before, either the cash flows needs to be adjusted for the risk or the discount rate needs to be adjusted for the risk. In the question, basis on limited facts given, it was not told that whether the 30 lakh, the present value, the cash outflow expected is already adjusted for the risk or not, or the discount rate which have been used by the question to discount 50 lakh to 30 lakh present value was the risk adjusted discount rate or not. But additionally, question is talking about that management estimates 5% of the present value is the risk associated. So that's why we have, it is implied in the question that neither the discount rate nor the cash outflows were risk adjusted, right? So hence risk adjustments has to be done now. Now, otherwise, because the question is saying 5% is the risk of the actual outflows would be more from the expected present value, right? Expected present value. That's why we have considered 5% on the straight away on the present value. Had the question said that 5% risk adjustment has to be done to the liability amount, then we would have done 50 lakh plus 5%, right? So 50 lakh plus 5% of 50 lakh. How much it would be? 52 lakhs and 50,000, right? Now, we would have calculated the discount rate, taken in the question. So we need to calculate that 30 is equal to 50 into 1 plus x to the power. And because 35 is the life, right? So this would be the equation in that case. We would have calculated the value of x by doing the mathematics. And then we would have applied this x to 52 lakh 52,000 had the question said that 5% is the risk adjustment needs to be done on the expected outflow at the end of the 35 years, right? So in that case, we would have adjusted the risk on the 50 lakh and then we would have discounted 52 lakh 50,000 again at the same discount rate and whatever would be the value would have been the present value. So we just need to understand what the facts are given in the question and basis on that we need to perform the calculations, right? Is it clear now? Because here entity is estimating 5% risk adjustment on the straight away present value. So that's why we have added to the present value. If instead of saying present value, the question would have said 5% of the expected outflow at the 35-year end, then we would have done the calculation accordingly, right? So risk adjustments would have been done to the 50 lakh cash outflow. Then that cash outflow would have been discounted at the discount rate, which is already being considered in the question. Although that is not given, but we can compute that. So we would have computed the discount rate first, and then we would have applied that discount rate for 35 years to compute the 52 lakh 50,000 liability present value for 35 years. I hope it is clear now. Okay. So we have understood the measurement rules, most likely outcome method, expected value method, and then present value rule, which we need to apply in any case, right? Now, there are certain other rules. For example, future value. Future events that may affect the amount recognized to settle an obligation shall be reflected in the amount of provision where there is sufficient objective evidence that they will occur. Now, any future event which are about to,
occur in future, if they are going to impact your provisions, then those needs to be considered, provided there is a sufficient objective evidence that those events will occur, right? So if we do not have sufficient objective evidence that those events will not occur, then we will not consider them. For example, the effect of a possible new legislation is taken into consideration in measuring an existing obligation when sufficient objective evidence exists that the legislation is virtually certain to be enacted. So in the previous session as well, we have discussed on this. So what we have discussed there is, if any law which is at draft stage and it is highly likely, that is virtually certain, that that law will be enacted. Now, if we are to be prosecuted under that law, then whatever the repercussions would be there on us because of that law enactment needs to be provided in the books as on date, even if that law is not yet enacted on 31st March, right? So that we have already discussed, and you might have discussed these things under IND AS 10 as well, adjusting non-adjusting events, which you must have already studied by now. So we are not doing anything new. This is same as in the IGAAP was also. X Chemicals Limited engaged in a chemical industry causes environmental damage by dumping waste in the river near the factory. So what the company is doing, they are just dumping the chemical waste into the nearby river, right? It does not clean up because there is no environmental legislation requiring cleaning up. And X Chemicals Limited is causing the damage for last 40 years, right? So for last 40 years, this chemical company is continuing dumping the waste into the river and polluting the river. And they are not doing any efforts in cleanup of that because as such, there is no environmental law in place. As at 31st March 2002, state legislature has passed a path-breaking legislation requiring all polluting factories to clean up the river water already contaminated, right? So on 31st March, there is a law which is about to be announced or notified. That law has already been drafted and passed by both the houses, right? But is still not yet notified as on 31st March 2002. Now, the company is preparing the financials on 31st March 2002. They know that they have contaminated the river for last 40 years and law around that was not there in place, but now it is expected to be enacted in the next year. As on 31st March 2002, what is your answer? Do we need to recognize provision for this, or there is no provision required because there is no law enacted, as at 31st March 2002? Just simply say provision required, provision not required. So Abdul is saying provision is required. Shruti is also saying provision is required. Now, why the provision is required? What is the obligating event? Is it a present value, or is it a present obligation arising of past event? So past event, what is the past event in this case? That river has been contaminated. That is the past event, right? Now, because of that past event, there is a present obligation because law is about to be enacted, right? And this is a virtually certain that law will be enacted. It's a matter of fact, few days or months that it is not yet notified, right? As soon as it gets notified, there would be a liability. So present obligation is there because past event has already been occurred. We have been contaminating the river for last 40 years. That is the past event, right? Now, what would be the amount of provision? the effort or the cost to be incurred in cleaning up the river, or the provision for the penalties or fines which needs to be paid under the enacted law. That the question comes. So number one, whether the provision is required or not. Yes, provision is required, that is for sure. Right. Now the next question comes, what would be the measurement criteria of the provision? Whether it will be the expected cost to clean up the river, or the expected amount of penalties and fines which will be payable for the default under the law, right? So that we will decide basis on the facts given in the question. Because we have limited facts in this question, we do not know what would be the measurement criteria. Now there could be two scenarios. Scenario one, if company has already started incurring the cost, or putting the efforts in cleanup of the river, so they have hired a contractor who is whose business is to clean up the river, and that contractor has quoted a cost of rupees say 2 lakhs to the company, and it will take say 1 year for them to clean up. Then 2 lakhs would be the amount, right, which would be incurred to clean up the river, right? So if the contract has already been signed and the contractor has already started working on that cleanup activity, then if the contractor has already done say 1 month job out of the 12 months job, then 1 month equivalent provision would be required to be made for the invoices expected from the contractor for the first month, right? So that would be the provision amount which we will be recording. If there is no efforts yet initiated by the company, then the expected provision amount would be the penalties and fines which would be payable by the company in case of default, right? Now, moreover, even if the company has already started cleaning up, even then, if law requires that there would be certain minimum, fines or penalties, so that best estimate we still need to do and we need to record. So there would be two types of provision: provision for the cleanup effort already, done by the company, and plus provision for the expected penalties and fines which will be mandatorily payable by the company, right? So summation of the two would be the required amount of the provision needs to be recorded in the books as on 31st March 2002. Clear point? So there is no thumb rule that what amount would be the provision amount. Basis on the facts and circumstances, we need to assess what expected liability company is about to incur. That expected liability has to be the provision amount, right? So the obligating event in this question is the contamination of the water, right? Because of the virtually certainty of legislation requiring cleaning up and outflow of resources is certain, it is possible to arrive at the best estimated cost for the cleanup activity. So provision should be recognized in the books as at 31st March 2002. Clear? Okay. Expected disposal of assets. So we are still in the process of discussing the measurement rules, right? So we have studied expected value, method of measurement of the provision, most likely outcome method of measurement, then present value factor which needs to be considered for discounting the provisions to be settled after 12 months from the reporting date, right? Where the time value of money is material, right? Then thereafter we have discussed future events which needs to be considered while measuring the provision amount. Now another rule is expected disposal of assets. Gains from the expected disposal of assets shall not be taken into account. Shall not be taken into account, right? Shall not be taken into account in measuring a provision. So what it is saying, whenever we measure any provision amount, if there are any expected gains which will be derived by, disposal of certain assets, right? That will not be considered for measuring the provision amount. So let's understand with an example. At the end of 2001, an entity is demonstratively committed to the closure of some facilities, having drawn up a detailed plan and made appropriate announcements, right? So some of the facilities are, expected to be closed by the entity, for which entity is committed, and they have laid out the detailed plan around that and also made appropriate announcements about the plan. The expected impact of the plan is as follows. Committed closure cost 10 lakh, and the facilities which will be closed. So whatever the property, plant and equipment or other assets would be there in those closed facility, if the company sells all those assets, then there would be a gain of rupees 2 lakh, which will be realized eventually by selling those assets. Now, in this case, provision needs to be recorded in the books at rupees 10 lakh. So for the sake of simplicity, we are ignoring discounting here. So 10 lakh would be the provision amount, and expected gain on the sale of the related assets which are there in the facility which is about to be closed will not be deducted or considered in calculating the provision. So provision will be recorded by full amount, that is 10 lakh rupees, and that 2 lakh gain, because it is pertaining to the sale of property, plant and equipment, that will be dealt in accordance with the derecognition criteria under IND AS 16, right? So you must have studied when the plant and machinery or other assets accounted for under IND AS 16 are sold, how they needs to be dealt with, right? So that accounting will be covering that aspect. So for the purpose of IND AS 37 provision measurement, we will not consider this item at all, and this will not impact my measurement of the provision. So provision will be recorded at its full value. Clear? So very, very simple rule. Just the rule is that if there are any expected disposal of assets, then any gain or loss arising on that needs not be considered in the provision amount. So provision amount is independent of this activity. That activity is, needs to be assessed and accounted for under the respective standard, right? Okay. So these are very small rules, basically, which we need to, keep in our mind while, doing any of the questions in IND AS 37. Reimbursements, again, another rule. In case of expenditure required to settle a provision is expected to be reimbursed from another party or by another party, the reimbursement shall be recognized when and only when it is virtually certain that the reimbursement will be received if the entity settles the obligation. So suppose there is a liability which needs to be settled by the company, and there is an expected reimbursement from any third party if the company goes and ahead and settles that liability, and that reimbursable right is virtually certain, right? So in that case, reimbursements shall be recognized. If that reimbursement is not virtually certain, then that will not be recognized. The reimbursement shall be treated as a separate asset. Reimbursement shall be treated as a separate asset. The amount recognized for the reimbursement shall not exceed the amount of the provision. So if we have a liability to settle of rupees, say 1 lakh, and we have the right to, reimburse from any third party, say, for example, government, insurance company, whoever, is giving us a reimbursement, and it says that 60% of the amount will be paid or 75% of the amount will be reimbursed once you settle this obligation, then that asset we can record separately, and we will record a provision as well for the amount which we are supposed to settle. In the statement of comprehensive income, the expense relating to the provision may be presented net of the amount recognized for the reimbursement. So suppose 1 lakh is the liability which I need to pay, and 50,000 is the amount that the insurance company, oblique government, or oblique any other entity will be reimbursing me. Then I can present net of that reimbursement amount in my P&L. So instead of booking the expense by rupees 1 lakh, I can show it up by net of the reimbursement amount, right? So 50,000 can only be reflected in my P&L in that case. Let's try this question to understand it better. X Beauty Solutions Limited is selling a cosmetic products under the brand name B, but it is getting its product manufactured from Y Limited. So X Limited is what? The seller, right? And Y Limited is what? Manufacturer, right? It has an understanding and enforceable agreement with Y Limited that if the company becomes liable for any damage claims due to any injury or harm to the customer of the because of the cosmetic products, then 30% of the amount of liability will be reimbursed by the Y Limited. So X Limited is selling the products to the customers, and it has entered into an agreement with Y Limited, that is the manufacturer. If I receive any complaints about the product, causing any injury or harm to the customers, then whatever the liability I would be, discharging 30% of that amount, I will claim as a reimbursement from you. That is the arrangement. During the financial year 2001 and 2, a claim of rupees 30 lakh becomes payable to customers by X Beauty Solutions Limited. How should X Beauty Solutions Limited account for a claim that becomes payable? So I need to create a provision amount of rupees 30 lakh in my books. Yes or no? Yes. Provision will be required to be recorded. Now 30% of this liability, I will have a right to, get reimbursement from the Y Limited. So 30 lakhs into my 30%. How much? 9 lakhs. 9 lakhs is the expected reimbursement I will be getting from the Y Limited once I settles this 30 lakhs. Right? So how do I need to present in this case? Since the understanding results in an enforceable agreement, the reimbursement of 9 lakh, that is 30 lakh into 30%, shall be recognized as a reimbursement right, and the provision will be recognized for full 30 lakhs, right? The reimbursement right shall be treated as a separate asset and shall not be offset with the provision. So in the balance sheet, reimbursement right will be coming under other assets by rupees 9 lakh, and provision would be coming by 30 lakhs. So this cannot be presented on net basis, right? But in the statement of the P&L, the expense may be presented as 21 lakh after offsetting the reimbursement right. So in the P&L, right, I can present the expense, net expense, 21 lakhs, right? So in the P&L on a net basis, I can do the presentation if I want. That is not mandatory. You can certainly do a gross presentation in the P&L as well. But in the balance sheet, netting of this provision with the reimbursement asset is not allowed, right? So in the balance sheet, only the gross reimbursement right and the gross provision needs to be presented in the assets and liabilities. But in the P&L, net expense can be presented as required by this standard. Right? Clear? Let me know if any queries, doubts, anybody wants to ask. I'm waiting for your responses in the chat box. Okay, Abdul is saying it is clear. Anybody wants to ask anything? Shruti also confirmed it is clear. Manoj also said no doubts. Perfect. Now, so these were all the measurement rules which we have discussed while measuring the provisions we need to keep in our mind. Now, another point is change in the amount of the provisions. Change in the provisions, right? Or in the amount, right? Now, whenever we record any provisions, definitely there would be certain changes in going forward in the circumstances in future, right? So basis on the change in the circumstances, we will recalculate or remeasure the provision amount. Yes or no? Yes, because always provision needs to show up the truest picture of the expected liability to be incurred by the company, right? So if there are any changes in the facts and circumstances going forward, I will recompute or remeasure the provision amount. And if this needs to be decreased, I will be, decreasing the provision by crediting it to the P&L. If there is a further increase required, then I will be debiting again the P&L and, crediting the provision liability to increase it, right? So that is all the adjustments I have to make every time, right? Whenever there are any changes. Provisions shall be reviewed at the end of each reporting period. Each reporting period means if the company is listed company, they might be publishing their quarterly results. So it is a quarter, right? If the company is not equity listed but debt listed, then in that case, if it is required to present half yearly results, then for each half year, right? And if it is not listed at all, then annually. So whatever is the reporting date at which the financials are being prepared by the company, then these provisions needs to be reviewed from the perspective if there is any change required to be made in the amount or the estimate of the provision. And if there are any adjustments required, then those adjustments will be made to reflect the current best estimate. Current best estimate means basis on the latest information available, what would be the best expected liability amount which will be required to be settled by the company. If it is no longer probable that an outflow of resources embodying economic benefits will be required to settle the obligation, the provision shall be reversed. So suppose we had created a provision for, say, some repercussions because of the expected law which will be enacted, right? Now, once the law is enacted, law simply said that government will not be levying any penalty or fines for the past contamination. But if the contamination continues, then they will be required to, pay the fines and penalties. So for the past event, there wouldn't be any penalties or fines. Now, if we had recorded any provision basis on the advice of the lawyers or, any expert consultant, then that provision now will be reversed because the law enacted clearly clarified that for the past defaults, there wouldn't be any penalty, right? So that provision will be reversed because there is no outflow expected now. Change in the provision resulting from a change in the discount rate is treated as the change in the accounting estimate of the provision. Now, earlier the discount rate was used 10%. Going forward, company, sees that, there is an inflation situation in the economy and the discount rates have risen from the last year. And hence, we need to, change the discount rate as well to reflect the current market rate of interest. So earlier the rate was used 10%. Now it should be 12%. Then I will be using the 12% discount rate for the provision to be discounted now. So the change in amount because of that change in the discount rate is to be treated as change in accounting estimate, right? Because this is not a accounting policy that I have a 10% discount rate accounting policy. So that is not accounting policy. That is a best estimate basis on the economy interest rates. So if 5 years back, interest rates were somewhere in the range of 7 to 8%, then discount rate was matching to that. Now, because of, inflation or interest rates have been increased in the economy in the current year, then I will match up to that interest rate. So discount rate may get changed year on basis. So whatever the change is there because of change in discount rate, that needs to be accounted for prospectively. That is the change in accounting estimate. Once the amount of the obligation is crystallized, and there is no uncertainty associated with the obligation, the liability is no longer a provision, the same will be reclassified from as an element within the liabilities. So what is the difference between the liability and the provision? So provision is a liability of uncertain amount and timing, right? This we have discussed in the previous session. So the difference between the provision and liability is that liability is of certain amount and certain timing. So when it needs to be paid and how much it needs to be paid. When both the factors are clear, then this is called a liability. And provision is either the timing is not certain or the amount is not certain. That's why this is a provision and it needs to be remeasured at each date, right? But what the standard is saying now, once any provision is crystallized and there is no uncertainty involved, then it is no longer a provision. It becomes or steps into the shoes of the liability because now the timing and amount both are certain. So provision will be released and liability will be recorded. Let's do this question. Customer X made a claim of rupees 2 million for the liquidated damages. The entity is disputing the amount of the claim. Due to the uncertainty involved in the amount payable, the entity recognizes this as a provision. After negotiation with the customer, an amount is agreed at 1.5 million. So 2 million was the expected amount which will be claimed by the customer, and later on company has negotiated with the customer and agreed that 1.5 million if they pay, the customer would be withdrawing the case. Okay. As there is no uncertainty involved relating to the amount payable, it is no longer meets the definition of a provision and should be reclassified to the appropriate category within the liabilities. Right? So earlier customer has filed a claim in the court against the company for the liquidated damages. Right? Now company was contesting. So company has, recorded a provision of 2 million. That is the expected outflow. Later on, company has done a out of court settlement with the customer. Now customer is happy if company pays 1.5 million. Now the agreement has taken place. So amount is crystallized now. So earlier it was being recorded and presented in the books of accounts as a provision, because now the liability of 1.5 million is confirmed because both the parties have done out of court settlement. So 1.5 million will be the liability amount which will be reflected and 2 million provision will be released. Right. So earlier entry of 2 million will be released and the liability in the name of the customer, I will record in the books. Clear? Any doubts? Let me know in the chat box. Clear? No clear? Not clear? Any questions if you have? Okay, Shruti is saying it is clear. Others? Anybody wants to ask anything? Okay, thanks Manoj and Abdul for the confirmation. Okay, now there is certain other guidance given in the standard. A standard says, do not record a provision or do not provide for future operating losses, currency risks, political risks, maintenance or refurbishment of own assets, general restructuring projects, and general business risk. See, if the company expects that they will be incurring losses in the next year or next to next years or say for next 5 years, they will be into losses. Do I need to record a provision for that? Of course, no. Otherwise, every loss-making company would have recorded the provision for the expected losses in the future years, because companies, preparing the financial statements basis on the going concern, right? So we are not going to record if the company would be loss making in the future years now. So as and when the loss arises, that will be reflected in that period only now when the loss will arise. So for the future operating losses, we don't need to create any provision in the books of accounts, right? And we have never done that in the IGAAP too. So as such, there is no difference, but it's a matter of fact that IND AS wants to be more expressive as compared to the IGAAP standards. So in IGAAP, these were the things which were implied. We have never, seen them, talking about those things by that standard. But under IND AS, you will see that all the IND AS try to emphasize, or try to be more clarificatory in nature on various aspects, right? Same goes for the currency risk. So if I have any, liabilities in the foreign currency, then what would be the expected change in the currency in the upcoming 5 years? Do I need to record a provision for that? No. It's a matter of fact, only I need to reinstate my foreign currency liabilities as at the reporting date. So whatever is the spot rate on the reporting date, that needs to be used for reinstating the foreign, currency liabilities. But I don't need to factor in, into the foreign currency risk of the upcoming future years as on today, right? Same goes for political risk. Whose government will be there, BJP, Congress or others? If impacts my business, then I cannot create a provision that because the elections are coming in the next year and if, government gets changed, so whatever the support I was getting from the current government, I may not get that support in doing my business from the next government. Hence, there is a risk involved. Hence, there would be certain provision I need to make. No. So any such risks, currency risk, political risk, or future operating losses which are expected by the company do not need to be provided for, right? And had the standard did not clarify about this, I wouldn't have been providing for them, Maintenance, refurbishment of own assets. Like we have discussed the example around this in the previous session as well. Suppose airline company or shipping company are, required to perform, incur certain, cost for every 3 years or 5 years. So those are taken care by IND AS 16. So they are capitalized into the respective, airline or the ship and, gets depreciated over the useful life of that cost. If it is different from the main asset, which is airplane or the ship, right? So those are covered under IND AS 16. So those not need, there is no provision required for any expected maintenance or refurbishments of any of the property, plant and equipment. General restructuring projects and general business risks. So I do not provide for any of these items, right? Correct? So no provision for any of such matters. X Packaging Limited has two segments, packaging division and the paper division, right? In March 2001, the board of directors approved and announced a formal plan to sell the paper division. So paper division is to be sold. That is the plan which is approved and announced by the board of directors in June. Operating losses of the paper division are estimated to be approximately 50 lakh rupees during the period from April 2001 to the expected date of disposal. So starting from 1st of April till the disposal happens, 50 lakh is the expected loss the company would be incurring from the paper division, right? Management of X Packaging Limited wants to include the future operating loss of 50 lakh as a provision for restructuring in the financial statements for the period ended 31st March 2001. Can X Packaging Limited include these operating losses in a provision for the restructuring? So because there is a restructuring going on, company has two divisions, packaging and the paper. Paper division is to be sold under the restructuring plan. which is already approved and announced by the board of directors. Now the expected loss, of rupees 50 lakh is to be incurred in the intervening period, that is from the date of 1st April till the expected disposal or actual disposal happens for that paper division. So 50 lakh is the operating losses, because until the disposal happens, paper division will continue to operate. So that operating loss is 50 lakhs. Now company wants to create a provision in the books for rupees 50 lakh. What is your advice to the company? Provision required or provision not required of rupees 50 lakh? Okay, Shruti is saying not required. Others? Manoj is also saying no provision required for operating loss. Standard states that provision should not be made for future operating losses, right? Since IND AS 37 prohibits the recognition of the future operating losses, so X Packaging Limited should not include these future operating losses in the provision for the restructuring, even though these losses relate to the disposal group of assets, right? Now, major repair and maintenance. We have already discussed this in the previous session, just 5 minutes back, and now we are doing this discussion third time, right? So general principle is repairs and maintenance of the own assets cannot be provided for, right? So that's what we have discussed here. Do not provide for maintenance or refurbishment of own assets, right? So we do not provide for any expected repair and maintenance of the PP&E, right? For example, an airline is required by law to overhaul its aircraft once every 3 years. No present obligation that is independent of the entity's future actions. No provision is recognized. Depreciation takes into account of the previously capitalized overhaul cost under IND AS 16. So suppose 5 lakh is the overall cost which is to be incurred by the airline every 3 years, then that 5 lakh would have already been capitalized under IND AS 16 and depreciated over the useful life of 3 years, right? So that is already taken care under IND AS 16. Hence, there is no provision required for any such costs. Okay. An entity is in the airline industry, leases an aircraft. The requirements of the lease are such that the lease is obliged to maintain a airworthiness of the aircraft. Airworthiness requirements for the airline industry are the same whether the entity owns or takes the aircraft on the lease. The lease requires the entity to return the aircraft in the same condition as at the inception of the lease. What does the entity recognize a liability for this obligation? Or sorry, when does the entity recognize a liability for this obligation? So obligation is because of maintaining the airworthiness. So company has, instead of buying the aircraft, has taken the aircraft on the lease. For example, Indigo company has taken the aircraft on lease from another company. Now lease agreement says that you have to return the aircraft in the same condition as it has been given on the lease. That is, airworthiness has to be maintained. Now for maintaining airworthiness, there would be certain expenditure which needs to be incurred by the Indigo company. So when does the entity recognize a liability for this obligation? This obligation means maintaining the airworthiness? Now that's the question for you to answer me in the chat box. Please think through whatever we have discussed or understood in this chapter. Basis on that, just respond me in the chat box. Any luck? So Abdul is saying at the inception of the lease. Okay. Others? Manoj is saying no provision required. Okay. The overhaul and maintenance of an asset is a contractual obligation under the lease. In this case, the entity might accrue a provision for the overhaul and maintenance cost, which the entity releases as it incurs and pays the actual expenditure several times during the lease. So at the inception of the lease, I will be recording a provision because in this case, the aircraft is taken on lease and it is not, purchased, right? So as per the lease contract, I am obliged to incur certain additional costs apart from the lease rentals, right? So for the lease rentals, I have already recorded a lease obligation under IND AS 116, right? Now I need to record the provision amount for the additional items or additional expenses which I would be incurring on this lease agreement, right? Because this aircraft is not capitalized in my books and this additional cost has not been already capitalized. Hence, I need to record a provision for this because now this is coming as a liability from a contractual obligation. Because in the case of the purchase of the aircraft, I have no contractual obligation, right? But in the lease agreement, I have a contractual obligation to incur overhaul and maintenance expenditure every 3 years or 5 years. So that's why I need to record a provision and unwind it. And as and when it is discharged, it will be settled, right? So this is how the provision will be required and recorded at the inception of the lease. Any doubts on this? So if I apply the rule book, what is my rule book? What is past event? Past event is signing of lease agreement, right? And that agreement says I have to incur the expenses for maintaining airworthiness apart from the lease rents I am paying. So lease rent have already been, recorded as a lease obligation under IND AS 116, And this additional expenditure, which I would be incurring, say every 2 years, 3 years, or 5 years, whatever it would be, I need to record a provision for this as well and unwind it because I have discounted them and unwind it. And in the year I actually incur the cost, I will be releasing this provision amount in that year, right? Airworthiness is, of course, for the future. But what is the past event? Past event is a contractual obligation I have taken by signing the lease agreement. So that is the past event. And I have already started using the aircraft. So if I have started using the aircraft, so I am depleting the airworthiness, right? So for maintaining the airworthiness in the future, I have to incur some expenditure, say after 3 years. So for that, I need to record a provision because that is a confirmed obligation, present obligation arising out of past event to be settled in future. So only settlement will take place in future. Event is the past event. Past event is signing of the lease agreement, entering into the contractual obligation to maintain the airworthiness and usage of the aircraft. That is the past event. Right, Shruti? Any questions anybody wants to ask on this? Okay. Okay, now I have a lengthy topic to discuss. So what I was thinking, instead of picking up the concept and spending 30 minutes on that, I'm giving you a break for 15 minutes now. We will resume at 8:45 sharp. Is that fine? So break starts now. We will resume at 8:45 sharp. in the chat box. Please let me know in the chat box if we can start.
Okay, thanks for the confirmation, Abdul.
So now the next point we are going to discuss is the restructuring, right? Although we have touch based it briefly earlier, now we will discuss it at full length. Restructuring. What do you mean by restructuring? So restructuring is a plan devised by the management to change the scope of business or the manner in which the business will be conducted in the future, right? So restructuring can take, any form. For example, sale or termination or abandonment of any of the products or any of the lines of the business, right? Closure of the business locations. For example, earlier the company was doing the business in, say, North India and the South India. Now they are just closing one of the locations, for example, North India or the South India, or they are relocating their factory or business activities from one location to another location, right? Changes in management structure. So new management has come into place and the old management, is now out of the company. So there might be sometimes, change in the management. Fundamental reorganizations that have a material effect on the nature and the focus of the entity's operations, right? So, for example, there could be many more examples. So this is called the restructuring. So whenever there is any change in conducting the business, or be it related to the manufacturing, be it related to the marketing, or be it related to the location, or whatever broad level strategic changes are about to happen, which are forming part of the restructure plan for the business. Those things are called restructuring activities, right? Now, IND AS 37 says that whenever any business or any management, comes up with a restructuring plan, so there has to be certain provision for those restructuring activities needs to be recorded in the books of account as on the date when this plan has been finalized, approved, and announced, right? So provisions for such restructuring cost, which will be incurred in doing the restructure of the business, is recognized when and only when general recognition criteria set out for the provisions are also met. So general recognition criteria are what? Past event, present obligation, estimate can be measured reliably, and this is more likely than not. That is the probable. So 4 conditions we have been studying since, ages now. Number 1, past event. Number 2, present obligation. Number 3, probability. So outflows are probable. And number 4, reliable measurement. So these are the 4 conditions we need to test in each circumstances to come up with the decision whether the provision is required to be recognized or not. If any of these 4 conditions fails, then provision, of course, will not be recognized, right? So these are the 4 conditions. So what the standard is saying, because company has come up with some restructuring plan, right? And they have finalized, approved, and announced this plan. So there has to be some provision needs to be recorded in the books of account as on the date of the reporting date for the expected cost, which is called the restructuring cost, which will be incurred by the company for, getting this plan implemented. Provided general conditions or general recognition criteria of the provision are satisfied. So these are the general recognition criteria. Now, an obligation to restructure arises only if the entity has detailed formal plan for the restructuring. So once the detailed formal plan of the restructuring is there, detailed formal plans means plans should be having enough details, basis on which expected outflows can be estimated, and it has to be formalized. Formalized means it has to be approved by the approving authority and announced to the people affected. That is, raised a valid expectation in those affected that it will carry out restructuring through implementation or announcement of the main features of the restructuring. Those affected means who can be affected? Maybe it employees. For example, if company has come up with, termination or sale of any of its division, then the employees working in that particular division will be affected. Number 2, suppliers of raw material for that division may also get affected, right? So all these affected people, whoever, will be impacted or affected by this restructuring plan, are communicated about the restructuring plan, right? So that is called raised valid expectation in those who are affected because of the restructuring plan being carried out by the company. Now, what we need to do? Identifying at least the business or part of the business concerned. So we will first of all identify as part of the restructuring plan that what business or part of business, to which this restructuring plan relates to. For example, if a company is manufacturing, say, for example, shampoos and the soaps. So there are 2 divisions, shampoos and the soaps. Now company wants to sell the shampoos division, or company wants to abandon the shampoos division. Then people who are associated with the shampoo division, the employees, the suppliers, or anybody else, whoever is affected because of this restructuring plan or decision, has to be communicated about the restructuring plan. And the plan should clearly identify that shampoo division is going to be restructured or abandoned or sold. Its principal locations which will be affected. So which all locations in which the shampoo division has its operations needs to be, mentioned in the restructuring plan. The location, functions, and the appropriate number of employees who will be compensated for getting their services terminated needs to be identified. So which all employees will be affected, that is, they will be either terminated or transferred to other, division or operations or business line of the company. So those identification of those parties who are affected, location which will be impacted, and all the functions which are affected by this restructuring plan has to be clearly identified and explained in the restructuring plan. The expenditures that the company will be liable to incur for, carrying out this restructuring plan needs to be, identified, and the date when the plan will be implemented, that is when it will be effective, the date also needs to be, mentioned in the plan. So this is called the details of the plan, which has to be there in the restructuring plan in order to say that the plan is formally, approved and it is having enough details, right? Now, no obligation arises for sale of an operation until there is a binding sale agreement. Suppose if company wants to sell the shampoo division, so unless and until company has identified a buyer with whom company has entered into a sale agreement for selling the shampoos division, until then, no obligation arises on the part of the company, right, for the sale. So there has to be a binding sales agreement between the company doing the restructuring and the buyer for purchasing that division which the company wants to sell, right? When the sale of the operation is envisaged as part of restructuring, the assets of the operations are reviewed for impairment under IND AS 36. Now, you must have studied IND AS 36 impairment of assets. Under that standard, whenever there are indicators, then we need to assess if the asset is impaired or not. How do we assess that? By comparing the carrying amount of the asset with the recoverable amount of the asset. Yes or no? Yes. So what we do there, whenever we apply IND AS 36, so we compare the carrying amount with recoverable amount. Yes or no? If carrying amount is higher than the recoverable amount, it means that asset is being carried at a higher amount what would eventually be recoverable from the asset. Hence, it needs to be brought down by that much amount. So this delta would be called the impairment loss. Impairment loss, right? Now, if a company is announcing a restructuring plan and that restructuring plan says that this division needs to be abandoned or sold out or whatever, then it clearly indicates that the need for this restructuring is maybe because the asset, is getting impaired. So there are indicators whenever any restructuring plans announced. So what the standard IND AS 37 is saying, it is saying whenever you come up with the restructuring plan, then you need to test all the assets under the restructuring plan under IND AS 36 for its impairment test. And if there is any impairment loss, then that has to be recognized first. So we will recognize the impairment loss first. And then restructuring provision we need to compute, which will include only direct expenditure arising from the restructuring, which are both necessarily demanded by the restructuring. That is, this expense will be incurred only if restructuring takes place. Only if restructuring takes place. Otherwise, this expenditure will not be incurred. Or it is not associated with any of the ongoing activities of the company, right? Any questions till now? So restructuring can be of any size and shape. Maybe it is a sell of a business division, to change in the location of factory or the business operations, or it may be abandonment or close down of a business division or a product line, whatever. So whatever restructuring it would be, there is always an indicator of impairment of the underlying fixed assets or property, plant and equipment or intangible assets, with that division. So first of all, the standard says go ahead and do the impairment test under IND AS 36 for all the assets under the restructuring plan. If there is a impairment loss, then that impairment loss has to be recognized, okay, under IND AS 36 first. Then I will come to the restructuring plan and see what additional expenditure company is going to incur if they go ahead with the implementation of the restructuring plan, right? So those expenditure which are directly dependent on the restructuring, That is, if the restructuring is taking place, then only this expenditure will be incurred, otherwise not. Required to be recognized as a provision under IND AS 37. Getting my point? Now, restructuring provision does not include the cost of retraining or relocating the continuing staff, marketing of the new business or after the restructure is done, and investment into the new systems and the distribution networks. So if we are going to purchase any new property, plant and equipment, we are going to set up new distribution networks, we are going to purchase new software or systems. So that is the new investment post restructuring is done, right? So those costs will eventually be recorded under the respective standard. For example, if it pertains to purchase of new assets, then IND AS 16, right? If it pertains to purchase of new intangible assets, then IND AS 38, right? So all these expenditure which will be there post restructuring will be accounted for under IND AS 16 and IND AS 38 if it is related to investment into the new assets or new intangible assets. If any of the marketing expenditure needs to be incurred by the company to advertise the post restructuring business, those marketing costs will come into the P&L as and when they are incurred. So as such, no provision is required. Retraining or relocating continuing staff, so this again will be the cost post restructuring. So the provision is required only for those costs which is pertaining to the restructuring activity, not to the cost which will be incurred after the restructuring is done or which is not related to the restructuring at all. Let's do a quick question first to understand it better. On March 12, 2001, the board of the entity decided to close down a division. Before the end of the reporting period, that is March 31st, 2001, the decision was not yet communicated to any of those who are affected, and no further steps have been taken to implement the decision. It is assumed that reliable estimate can be made of any outflows expected present obligation as a result of past obligating event. There has been no obligating event, and so there is no obligation, hence no provision is recognized because the plan is not yet communicated to the parties affected and it is not yet initiated for its implementation. So although the plan is drafted and approved by the management, but it is not yet announced or not yet communicated to the parties affected, and no implementation steps have been initiated yet. Hence, there is no restructuring as such in place. Hence, there is no past event which will be leading to any present obligation. Hence, no provision is required in this case, right? On March 12, 2001 reporting date, the board of an entity decided to close down a division making a particular product. On March 20, 2001, a detailed plan for closing down the division was agreed by the board. Letters were sent to the customers, warning them to seek an alternative source of supply, and redundancy notices were sent to the staff of that division, right? It is assumed that reliable estimate can be made of any of the outflows expected. Now, in this case, what would be the answer? Provision required or not required? That we will test basis on the general conditions. General conditions are past event resulting into a present obligation. So the obligating event is the communication of the decision to the customers and the employees, which gives rise to a constructive obligation from that date, because it creates a valid expectation that the division will be closed, right? Although it is not yet closed, but it will be closed because the plan has already been announced and communicated to the people affected. Hence, this is a past event. Past event is the communication of the restructuring plan. Past event is the communication of the restructuring plan affected by the plan to the people affected by the plan. Now, whether it will result in an outflow of resources? Yes, because that is probable, because now once the restructuring plan is initiated, cost will be incurred for those restructuring activities. So this is more likely than not that expenditure, restructuring cost will be incurred by the company, right? So past event is there, present obligation is there, probability is there. Hence, a provision is recognized as at 31st March for the best estimate of the restructuring cost, which will be incurred by the company. So reliable estimate is a condition which is deemed to be satisfied, although question has clearly called it. It is assumed that reliable estimate can be made. So all the four conditions. Number one, past event. Past event is what? Communication of the restructuring plan. Present obligation, yes, because past event has occurred, so obligation is a present obligation. Probability of the outflow, yes, because there will be certainly some cost which will be incurred. And measurement, right? So all the four conditions are satisfied, hence provision needs to be recorded in this case. Any questions? Doubts? Let me know in the chat box. If it is clear, say clear. If there is any query, let me know what is the query. I am happy to take it up now. Okay. Thanks, Viraj, for the confirmation. Others? I saw your response in the chat box, Viraj, after a long time. Okay. So Manoj, Abdul are also confirming it is clear. Fine. Restructuring other matters. Gains on the expected disposal of assets should not be taken into account in measuring a restructuring provision, even if the sale of assets is invested as part of the restructuring, right? So this is the same concept which we have discussed earlier as well. So if there are any corresponding assets in that division which is eventually being sold out or abandoned, so if we sell those assets, there would be any expected gains which we would be making out of those assets, so that will not be considered, shall not be taken into account, right? Shall not be taken into account in measuring the restructuring provision. So this is the same in line with other provisions as well. So if there is anything which will be realized out of the sale of the assets, then that will not be considered for the measurement of the restructuring provision. Includes only direct expenditure arising from the restructuring that are both necessarily entailed by the restructuring and not associated by the ongoing activities of the entity. So only those items or those costs or those activities which will eventually be coming up only because of the restructuring plan are to be considered for, calculating the amount of the provision required to be made, right? If there are any activities which anyway would occur, be there is a restructuring or there is a no restructuring plan, then those costs will not be called as restructuring cost. Hence, those are out of the scope of this restructuring provision. Does not include such costs for retraining, relocating of the continuing staff, marketing or investment in new system and distribution networks, right? This we have already discussed in the previous slide as well. So basically what we need to focus upon is whatever the cost pertaining to the restructuring plan are incurred or expected to be incurred only if restructuring plan is there. Those costs only needs to be considered. Otherwise, those costs will not be regarded as direct cost, hence needs to be ignored. Let's try our hands on this question. X Siemens Limited has 3 manufacturing units situated in 3 different states. The board of directors X Siemens, in their meeting held on January 10, 2001, decided to close down its operations in one particular state on account of the environmental reasons. A detailed formal plan for shutting down the above unit was also formalized and agreed by the board of directors in their board meeting, which specifies the approximate number of employees who will be compensated and the expenditure expected to be incurred to carry out this restructuring activity. Date of implementation of the plan has also been mentioned in the plan. Meetings were also held with the customers, suppliers, and employees to communicate the features of the formal plan to close down the operations in the said state, and the representatives of all such interested parties were present in those meetings. So, company has conducted the meetings with the people affected and communicated the details of the plan and the date by which the plan would be effective. Does the actions of the board of directors create a constructive obligation that needs a provision for restructuring in this case? So provision required, provision not required. That is the question. So what do you think in this case? Provision for the expected restructuring cost because of the implementation of the restructuring plan is to be recognized or not recognized? Again, we go back to the 4 conditions. What are those? Number 1, past event. ये तो रट जानी चाहिए. Number 2, present obligation. Number 3, probable outflow. Number 4, reliable estimate. Right? So these are the general conditions. Plus additional conditions. What are those? Direct nexus with the restructuring plan. So cost must be, incurred only if restructuring takes place. Right? So direct cost because of restructuring. Right? And what is the second condition? Plus number 1, number 2. What is the number 2? Number 2 is plan has been communicated. To affected parties. Right? So 4 conditions, the general conditions, plus 2 conditions, the specific conditions. All the 6 conditions we need to test in order to come up with the answer whether the provision will be required or provision will not be required to be recognized in the books. Now you tell me. So Abdul is saying provision not recognized. Okay. Manoj is saying yes, provision is required to be recognized. Okay. Others, please respond. Others? Praveen Kumar is saying provision to be considered. Okay. Okay. As per IND AS 37, the conditions prescribed are there should be a detailed formal plan of the restructuring, which should have raised valid expectations in the minds of those affected that the entity would carry out the restructuring by announcing the main features of its plans to the restructure. The board of directors did discuss and formalize a plan of winding up the operation in the above said state. The plan was communicated to the parties affected and created a valid expectation in their minds that X Cements Limited would go ahead with its plan and close down the operation in that state. Thus, there is a constructive obligation that needs to be provided at year end. Right. So, two conditions. Form plan has been detailed out and it has been communicated. Right. These two conditions are getting satisfied. General conditions. Past event. Past event is what? Plan has been communicated. Present obligation, because plan has been communicated. So this gives a rise to the present obligation, right? Probability, because plan is, underway, implementation. So it is highly probable that cost will be incurred. That is the restructuring cost. Fourth, reliable estimate. It is always deemed that estimate can be made unless and until question specifically calls that out, that reliable estimate cannot be made. So fourth condition is always deemed to be considered satisfied unless and until facts and circumstances in the question specifically calls out a reliable estimate cannot be made. If the question says reliable estimate cannot be made, then only, we will say that fourth condition is not met, hence the provision will not be recognized. Getting my point? So fourth condition is always considered to be deemed satisfied unless otherwise stated in the question. Please note it somewhere. Reliable estimate condition. That is the general condition, fourth condition. Deemed satisfied. Satisfied unless question specifically calls out that reliable estimate cannot be made. Okay. So this condition we always considered as deemed satisfied. Rest all general conditions are satisfied and two special conditions pertaining to the restructuring are also satisfied based on the facts given in the question. Hence provision will be required. Any doubts? Questions? Abdul, now it is clear to you? You were saying that provision is not required. Anybody wants to ask anything? Till now, whatever we had discussed. Okay. Now, there are certain disclosures required by the standard for each class of provision, right? For by the class of provision, we need to make these disclosures. What are those? Number one, carrying amount at the beginning of the period. So, opening balance, opening provision amount, right? Then additional provision made. So, additions, if there are any, right? Then any liabilities which have already been incurred and settled during the period. Any amounts which we have reversed basis on the change in the information or circumstances made available to us during the period. Then plus discounting effect. Okay. Unwinding of the discount. like we have discussed. And then this would be the closing balance. So this tabular presentation we need to make for all major categories of the provisions, right? So we have to showcase the movement from the opening balance plus additions minus release plus discounting effect is equal to the closing balance. So this tabular presentation we have to give. Now standard is specifically saying that comparative information is not required. Why comparative information is not required? Because standard has already asked this, table where the opening balance is already there. That's why comparative information is not specifically required, right? So only current year disclosure or current year information needs to be disclosed, starting with the opening balance, ending with the closing balance, and capturing all the movements of additions and releases in the provision, right? So this is the disclosure required. No comparative information. No comparative information. Okay. So this comparative table of the previous year is not required. Okay. Only current year table is required. Now for each class of provision, brief nature. What is the nature of the provision? Why it is created? What is the brief description? What is the timing when this provision will be eventually paid or required to be paid? And what are the events which is related to the provisions which are creating uncertainties? That's why this is the provision. So for example, if a provision is for a tax or for a case law, then court decision is the uncertainty, right? Court decision. So we have to explain for each class of provision what is the nature, what is the description, what is the timing, and the uncertainties involved. Then expected and recognized reimbursements. Expected and recognized reimbursements relating to the provisions, if any. So if there are any reimbursements which I will be getting from the third party, like the question we have discussed for a company where they were getting cosmetic products manufactured with other manufacturer with an agreement. If there is any defect and it causes harm or injury to the customers, then 30% of the claim amount the company will eventually be incurring is getting reimbursed from the manufacturer. So we have to say that, boss, I have created a provision of rupees 50 lakh for this, claims which I have received from the customer. And since 30% is the reimbursement right I have from the manufacturer, so expected and recognized reimbursements I will also disclose in my disclosures. And these reimbursements pertains to which provision, that I need to clearly call it out in the disclosure, right? If it is impracticable to disclose any information, the fact shall be stated. So if there is any information which is required to be disclosed about the provision and we are not able to compile that information for any XYZ reason and it is impracticable for us to do so, then instead of, skipping that information and doing nothing, we have to say that this particular information is not available for so and so reason. Hence, we are not able to disclose this information. For example, if we do not know the timing by when the provision will eventually be required to be settled, and we cannot estimate the expected timing, then we need to say why this timing factor is not, we are able to estimate. So we have to disclose any information which is ideally required to be disclosed. If we are not able to do so, then what is the reason behind that? That needs to be disclosed. Now, that's all were the disclosures around provisions. Now, contingent liability. Contingent liability, we know that it is not recognized, right? And only disclosures required. Right? Now, condition is whether the possibility of any outflow in the settlement is remote. If the answer is yes, then this is not even a contingent liability, because Liability is remote, that is less than 5% chances. Less than 5% chances. Although these limits are not given in the standard, this is just for the sake of understanding and, discussion only. So no disclosure required because this is not to be treated as contingent liability even, right? So no disclosure. If the chances are not remote, then disclose for each class a brief description and the nature. So description and the nature, two items required to be disclosed for the contingent liability along with the amounts. Estimate amounts. Right? So for contingent liability, we know that no accounting is required or prescribed by the standard, only disclosures are required. But if contingent liability is a remote, that is less than 5% chance of getting this, crystallized, then no disclosure even required. If the chances are not remote, then only disclosures are required and description and nature of the contingent liability needs to be disclosed. Now, the third item for contingent assets, whether the inflow of economic benefits is probable. If no, then no disclosure required because it is not probable that there will be any inflow. So this is not a contingent asset even. So contingent asset means when the inflows are probable, that is more likely than not, more than 50% chances. Right? More than 50% chances that company will be getting some inflows of cash or other assets, right? So in that case, it becomes a contingent asset. Now, contingent assets are also never recognized. Right? Because we only record assets. We do not record contingent assets in our books of accounts, right? So never recognized, only disclosures. Right? Now, if outflows are less than 50% probability, then even then disclosures are also not required. But if it is probable that inflows will be there, sorry, I'm using the word outflow, inflows will be there, then a brief description and nature of the contingent asset and an estimate of their financial effect. So that is required to be disclosed. Any doubts, queries, questions? Thanks, Viraj, for the confirmation. Others? Anything anybody wants to ask at this stage? Because we have covered almost, all the topics we were expected to cover in this standard. Anything anybody wants to ask? Thanks, Abdul, for the confirmation. Okay. Now, there are certain differences between the IND AS 37 and the corresponding standard under IGAAP, right? What are those? Number one is discounting. So under IGAAP, we have never discounted the provisions. So Abdul is asking, is contingent liability / contingent asset disclosed as footnote? Yes, that has to be disclosed as a disclosure in the notes to accounts. Correct. So there is a specific section which needs to be there in the disclosures. One say for contingent liabilities, then next for contingent assets. Manoj is asking, in assets, probability greater than 50%. In liabilities, probability greater than 5%. Contingent disclosure. See, try to understand. So when I say I need to assess the probability. So for contingent assets, probability should be there, more likely than not. That is more than 50% chances of getting the right to receive those inflows, right? Then only I can say that this is a contingent asset, because it is still dependent on some contingent event, right? So that's why, because of that contingency, they are not clear assets as on today. Since they are not clear assets as on today, I cannot show them or record them in my balance sheet as assets. That's why I am giving a disclosure of the contingent assets, because they will be assets once the contingency gets cleared, right? So that's why it should be probable, that is more likely than not. In case of contingent liability, the chances, if are remote, then there is no contingent liability even. So chances should be greater than 5% for contingent liability disclosure, because contingent liability is the liability which will be confirmed once the future event happens, on which it is dependent, and the chances are not remote. So if chances are remote, that is less than 5%, then there is no contingent liability even. If chances are not remote, that is more than 5% chances are there that there would be something coming up to the company to be payable, then that is called a contingent liability. If chances are more than 50% for any liability, then it will come as a provision only, right? Because provision says that okay, let me discuss it again. Find some space. Okay. So in the provisions, provisions and contingent liability, right? Provision, condition number 1, past event. Condition number 2, present obligation. Condition number 3, probable outflow. And condition number 4, reliable estimate. Right? So in case of provision, the third condition, probable outflow, what this condition means, that outflow will be there, chances are more than 50%. So more than 50%. Right? So more than 50% of the chances are there that there will be outflow. That's why it is called provision and needs to be accounted. If chances are less than 50%, right? In that case, can I say it is a provision? No, because it is not more likely than not that liability will be incurred. So in this case, it will become a contingent liability, because chances are less than 50%. But standard says if chances are less than 5%, that is remote, that company will be incurring anything. So even this is not qualifying as a contingent liability. So 0% to 5%, no contingent liability. 5% to 50%, contingent liability. 51% to and above, right? 100%. So it is a provision. Getting my point? Now it is clear. Abdul and Manoj, clear this point? So if chances are less than 5%, standard says it is not even contingent liability. If chances are between 5% to 50%, then standard says it is a contingent liability. Hence, provision is not required to be recognized. Only a disclosure of contingent liability is required. If chances are greater than 50%, then provision needs to be recognized. It takes the shape of a provision. Now, for contingent asset, so if chances are 100% confirmed, then this is asset, right? Needs to be recognized. If chances are 51% to 100%, right? Then this is a contingent asset, right? And if chances are less than 50%, then nothing. Clear? So although standard does not prescribe these limits, it is just for our understanding, right? Standard will always use the word probable, more likely than not, highly probable, remote. So all these qualitative words will be there in the examination question, right? But for our understanding of the concept, these limits, we generally use. So there is no limit. You cannot write in the examination in the answer that chances are less than 5%. You always use the word chances are remote. Okay. Hope I am clear on this. Don't get confused. Whatever, limits are there. So these limits are not prescribed by the standard. We cannot, make them use in our answer. This is only for our understanding. I hope everybody is clear now on the contingent asset and contingent liability. Okay. So we were talking about the differences between the IND AS and the IGAAP. So number one difference is discounting. So under IGAAP, we have not been doing the discounting, right? But because IGAAPs are also revised to some extent in line with the IND AS. So because IGAAP AS 10, fixed asset, which is renamed as PPND now, is revised in line with IND AS 16, IND AS 16, right? So IND AS 16 talks about the decommissioning liabilities needs to be accounted for, and IND AS 16 requires the discounting to be given. So by virtue of being revision made in AS 10, other provisions are not to be discounted, but decommissioning liability and restoration or other similar liabilities related to the property, plant and equipment needs to be discounted. Getting my point? And under the IGAAP. So as such, on plain vanilla, all the provisions are not required to be discounted except for decommissioning liabilities, restoration and rehabilitation of sites, etc. All such provisions which are related to the IND AS 16 property, plant and equipment, right? So those needs to be discounted under IGAAP as well, because AS 10 has been, amended in line with the requirements under IND AS 16. And since IND AS 16 talks about all these decommissioning, restoration liabilities and discounting is required, so IGAAP, under IGAAP, discounting will be done for these provisions only. Clear? Number two, contingent asset. So there was no such term under the IGAAP, neither recognized nor disclosed, or basically the silent, I would say. Okay. So IGAAP is completely silent on what contingent asset means. So they do not define contingent asset at all. Under IND AS, contingent assets are not required to be recognized. Only disclosures in the financial statements are required when the inflow is probable. Inflow is probable. Impairment loss. IND AS 37 specifically talks about that impairment loss needs to be considered under IND AS 36 whenever there are indicators on account of any restructuring being carried out by the company, or if there are any onerous contracts, for that entity where the loss, the contract is a loss making. So IND AS 37 is specifically covering this aspect, but our IGAAP standard AS 29 is silent. on this aspect as well, right? Clear? So these are the key differences. As such, there is no key gap difference between the IND AS and the corresponding IAS 37 IFRS series. So whatever is there in the IFRS series IAS 37 is equally, there in IND AS. So there is no carve-ins or carve-outs as such. Okay. Now let me know before I start with some of the MCQs asked in the previous examinations. Any questions, doubts, queries, concerns, anybody wants to discuss on any matter, whatever we have discussed in the previous session as well as in today's session. So I'm happy to take them up first before I proceed with the MCQs. And if there is nothing, just type clear or no doubts so that we are on same page. Okay, Manoj said no doubts. Others? Okay, then let's start with the MCQs. In accordance with the requirements of IND AS 37 provisions, contingent liabilities and contingent assets, where measurement uncertainty exists, which one of the following methods is not an appropriate valuation for a provision based on accounting standards? The midpoint of a range of equally likely outcome of expenditure. No provision should be recognized where the measurement uncertainty exists. The minimum amount expected to represent the best estimate where other option is omission, and most likely amount expected to represent the best estimate where there is a single obligation. Not an appropriate valuation. Which of the following is not a appropriate valuation? Not a appropriate valuation. A, B, C, or D? Viraj is saying B, Abdul is saying A. Okay. At least I should get 5 to 6 options, answers. Not options, but the answers. 5 to 6 answers at least, so that I get to know that you are thinking through the MCQs and trying to respond them, rather than me simply talking and discussing the solutions. Manoj is saying C. Okay, so A, B, C have all come up. D is the only option left. The correct answer is option B. As outlined in the module, where measurement uncertainty exists, the provision amount should be estimated based on the circumstance. Measurement uncertainty does not suggest that no provision is required. So if there is a measurement uncertainty, then it does not mean that we do not recognize provision. We factor in that uncertainty. If we can say that estimate cannot be made, then only we skip the recognition of the provision. Estimate cannot be made or estimate can be made with some uncertainty are two different things. Clear? If I say estimate cannot be made, then it means that no provision can be recognized because I do not have any amount by which I need to generalize the entry. But if I say there are measurement uncertainty, so that is the part and parcel of the nature of the provision. Na? Provision says liability of uncertain timing or uncertain amount. Have we discussed this definition? Yes. Provision is a liability of uncertain amount or uncertain timing. So amount is uncertain, but measurable. If I say it is not measurable, then only reliable estimate condition violates and I don't need to recognize the provision. But if I say that there is a measurement uncertainty, then I cannot say that provision is not required to be recognized. Clear? So MCQs becomes tricky sometimes, but we just need to stick to our basic rules. If we stick to basic rules, complete our checklist, we will come up with the right answer. Don't answer intuition based. Always tick on your checklist. Which of the following represents an appropriate discount rate for measuring a provision based on IND AS 37? Number A, market yields on national government bonds. B, market yields on high quality corporate bonds. C, pre-tax rate that reflects current market assessment of the time value of money and risk specific to the liability. Pre-tax rate that reflects current market assessment of the time value of money and the risk specific to the entity. A, B, C, or D. MCQs are scoring and, not time taking if we are clear on the fundamentals. So Viraj is saying A, Manoj is saying A. Okay. Others? Abdul is saying C. Okay. Nobody is liking B and D so far. Please try to respond. Supriya is Supraja is saying D. Okay. So A, C, and D are all availed. The only option left is B. Anybody wants to pick up B as well? Okay. Yedu Kondalu is saying C. The correct answer is option C. Paragraph 47 of IND AS 37 specifies that discount rate is to be a pre-tax rates or rates that reflects the current market assessments of the time value of money and risk specific to the liability. When we had discussed the discount rate which needs to be used, we have talked about on this that discount rates needs to be pre-tax and adjusted for the risk specific to the liability if cash flows are not adjusted. If cash outflows are already risk adjusted, then discount rate is not required to be risk adjusted, right? Now risk pertaining to what? Risk pertaining to that provision, risk pertaining to that liability, because there are certain risk or uncertainties involved for that liability, which is dependent on some future event. So risk pertaining to that needs to be adjusted, right? So risk is specific to the liability only, not specific to the entity. So entities risk we are not talking about. Provision risk or liability risk we are talking about. Clear point? So we just need to somewhere note down all these, key points whenever they come into the discussion for our quick revision before the examination. So whenever we note some important points in any of the practical questions or any of the MCQs, try to note down somewhere as key points pertaining to this standard or to this chapter, so that before the examination, you at least revise those key points. Because we do not have time to revise all the practical questions and all the MCQs. So whatever are the learnings we are getting from those practical questions or MCQs, we should note down somewhere. Okay. Just try to follow this practice. It will save a lot of your time in revision before the examination. Okay. Which one of the following is a correct statement in relation to the provisions and contingencies? A. An item of a contingent nature may be recognized but not disclosed in the body of the financial statements. B. IND AS 37 applies to the provisions to perform land rehabilitation activity. C. IND AS 37 applies to the contingent liabilities and contingent assets of the issuers that results from the insurance contract. D. Present obligation exists in all circumstances where a company may have some choice in whether or not to make a future sacrifice of economic benefits in the settlement of an obligation. So which one of the statement is correct statement? So one statement is correct out of the 4 statements. A, B, C, or D? Liking MCQs? Viraj is saying D. Okay. Others? Please try to think through and respond in the chat box. Manoj is also saying D. So ideal time to complete the MCQ in the examination is maximum 2 minutes. So if you are taking more time in MCQ, then it is not a good thing. MCQs should be completed within 2 minutes. Abdul is saying A. So A and D are availed. B and C are still open. Any other response? Okay. The correct answer is option B. Provision to perform land rehabilitation activity are not addressed by another standard. Accordingly, these provisions are within the scope of IND AS 37, para 1 and 5 of IND AS 37. Now, why other statements are not true? If I discuss them, I think it would be more clearer. An item of contingent nature may be recognized. So does the standard talks about recognizing any contingent liabilities or contingent asset? No. So contingent asset or contingent liability cannot be recognized or prohibited by the standard. But this statement is saying may be recognized. So this goes incorrect. Clear, Abdul? You were saying A. B. IND AS 37. Contingent liabilities and contingent assets applies to provisions to perform land rehabilitation activity. Yes. This is the correct statement. We have, seen this during the discussion, that anything which needs to be, replenished, rehabilitated, or, liability which needs to be incurred for, making the asset good as it was when it is received needs to be provided for. C. Provisions, contingent liabilities and contingent assets applies to contingent liabilities and contingent assets of the issuers that result from insurance contracts. So have we discussed this specifically? No. So these are all items talked about or covered by IND AS 104, right? Or the new standard 117, which will eventually be there, right? So these are specific standards which are talking about the liabilities of the insurer needs to be assessed, computed, and recognized and disclosed. So IND AS 37 does not talk about them, right? So again, this goes as incorrect statement. And D, a present obligation exists in all circumstances where the company may have some choice in whether or not to make a future sacrifice of the economic benefits in the settlement of the obligation. So this statement is clearly flawed, right? This is a clear false, because obligation exists only if, present obligation exists only if it is not impacted by company's future decision, right? Otherwise, the company can manipulate the obligation. Present obligation means that company is obliged to something which is not in the hands of the company. If it is in the hands of the company, company will never be obliged. Getting my point? So all these three statements I have proved false, and this statement is automatically correct. And if you go to the respective para 1 and para 5 of the IND AS 37, you will find it there. Okay. Clear? Manoj, Viraj, others? Any doubts? Still, after seeing and discussion of the answer, still somebody has any doubt or question on this? Okay. So in this case, option answer is already made available by chance. So still we can discuss. As at 31st March 2001 reporting date, ABC Limited is involved in a legal dispute with one of its supplier in relation to the early termination of the executive exclusive license arrangement between the two companies. The supplier seeks damages of 50 crore. The directors of ABC Limited believe that they will be successful in defending this claim. ABC's lawyers have advised that there is a 90% chance that the entity would not be liable for this claim. In accordance with the IND AS 37 provision, contingent liabilities and contingent assets, which one of the following is the most appropriate option for ABC while preparing its financial statements? Neither recognize provision nor disclose contingent liability. Disclose information about the possible liability as a contingent liability. Recognize a provision or recognize a contingent liability. So anyways, answer is there in the question. So why the option B is correct? Disclose information about the possible liability, that is contingent liability, because chances are 90% given in the question. And when we have discussed the limits, what we have discussed, if less than 5%, then no CL, that is no contingent liability. If greater than 5%, but less than 50%, then CL, that is disclose only. Right? If chances are greater than 50%, then provision. So where we are falling in this case? We are falling in this case. because 90% are chances that entity would not be liable. So 10% are the chances that entity will be liable. So 10% is coming between 5% to 50%. Hence, it will be treated as a contingent liability. Hence, disclosure is required. Clear? Okay. So that was it from my side on IND AS 37. I hope the session was informative and value add for all of you. I have tried to explain and cover all the aspects of the standard with enough number of practical examples and illustrations. If there is any sort of doubt, question, query, anybody wants to ask on any matter, I am happy to pick it up now. Okay, no question is coming in the chat box. I assume whatever we have discussed is understood. So I wish you all the very best. Please try to pick up some good practical questions from the study material and practice as many MCQs as you can so that concepts, gets crystallized. So with that note, I am winding up the session for the today. See you again in the next session. Thank you. Yes, session is complete. Thank you.